As we continue our week-long Beat the Street series where we profile some of the nation's top-performing fund managers, today we're sitting down with Jeff James. He runs the small-cap Driehaus small-cap growth fund. It is up 27% this year versus a 10% gain for the Russell 2000. We spoke with James earlier, and we asked him about his secrets to success, how he's managing to beat the street, and here's what he told us.
I think the environment for small caps is still quite good. Earnings growth has been very strong. Small caps have a more domestic focus in terms of the U.S.-centric, the U.S. economic environment. Economic growth has been accelerating in the U.S. on the back of tax cuts and deregulation. So their outlook for earnings is still quite good, and it's less exposed to some of the tariff issues and the economic mixed results and slowdown overseas like large caps are.
You know, with so much attention being focused by investors and also, to be fair, members of the media on the FANG stocks and a few other the big cap tech stocks, does it make it easier or more difficult to find these sort of underloved and undercovered names that you are obviously so successfully finding?
Yeah, we have a very rigorous process that's geared towards finding stocks that have the correct fundamentals in accordance with our investment philosophy. So we're looking for stocks that have accelerating results, are going through rapid change, that are going through growth inflections, that have a high likelihood of success in terms of beating estimates and having estimate revisions, taking market share in strong industries. So we're finding a broad number of ideas across a broad number of sectors.
Yeah, and you look at some of these names that you have found. For example, Tactile, one of your top holdings. How did you come across this company, and how much research do you do to say, okay, you know what, this is a company worth owning? How much time does it take?
Well, it takes quite a bit of time. We have a broad team of analysts that do an excellent job looking at companies with certain characteristics relative to our philosophy. Again, looking for companies with accelerating results, taking market share. So it's a matter of comparing the actual results and meeting with management teams and comparing that back to our investment philosophy. And once we find, being very selective, finding companies that have certain characteristics, we're able to find companies like Tactile and others that are outperforming or have the characteristics to outperform.
Yeah, talk to us about Tactile, the company, and not a name that I'm familiar with and covering. Don't think we've spoken with the CEO on CNBC. What does this company do, and what made them so attractive to you?
Yeah, a number of things. We've owned the stock since its IPO. Looking through the company's fundamentals and meeting with the company multiple times, it has certain characteristics, again, that are consistent with our philosophy. They've had very consistent results. They're taking market share. What the company does is it's a medical device company that focuses on treating patients with lymphedema, and it has data-supported products that produce a superior, very efficacious result. As they grow their sales force, they've been exceeding expectations very consistently. So ever since its IPO a number of years ago, it's been outgrowing the market, taking market share, and exceeding expectations. So it's really a matter of looking for the right characteristics and then buying the stock in a timely way.
Yeah, another one, just under $5 billion market cap that has been a powerhouse for your fund, Inogen. Again, not familiar with them. Who are they? How'd you find them? Why do you like them?
And that's the beauty of our approach. We're looking for companies that are not in the FANG universe, the companies that are much smaller but often growing at very exceptional rates. Inogen is also a medical device stock. It's been a top holding of ours since early 2016 when we bought initially in the $30 range. They make a medical device product called a portable oxygen concentrator, or POC. It's a device that provides oxygen therapy for patients with chronic respiratory conditions. It's a lightweight portable device that is really taking market share from the clunky oxygen tanks that have long been used by patients. So it's seen accelerating results, revenue growth going from 17% to 51% year over year over the last 5 quarters. They've been growing and taking market share because they provide a superior outcome, a better quality of life for patients. It's a very well-managed company that's been exceeding expectations. And there's a number of reasons why they've been growing so rapidly. One is the very rapid growth of their sales force, but that's not been a hit to their profitability. In fact, operating leverage and profitability has expanded quite dramatically. Consensus expectations are $2.11 for this calendar year. When estimates for this year debuted just over a year ago, they were at $1. So there's been earnings revisions to consensus expectations have risen by more than 100%. Their last June quarter, they had nearly a 50% earnings surprise and nearly a 20% revenue surprise. So the outlook for Inogen remains very strong, and we think estimates can be exceeded.